Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, November 1st, 2024. It's a great Friday, big Friday, huge Friday, as some would say. We got our monthly macro scouting report presentation out, going to be published this afternoon to 42 macro clients. That's certainly our flagship piece of research. We go through about 125-ish slides of high-end institutional content every month in those presentations with the webcast, usually about an hour and 15 minutes. I try to get through the presentation there, but the real key takeaway is, we're trying to help investors really understand the full distribution of probable economic outcomes so that they can make better informed investment decisions, particularly in response to the evolution of our quantitative risk management signaling process. So before we get on all that, let's just start with the executive summary from today's leadoff morning note. It's a fun leadoff morning note, given that the jobs report was as sloppy and as it was. Obviously, it was severely impacted by the hurricanes and the Boeing strike. So it's not like we learned particularly that much about the U.S. economy in today's jobs report. So let me just unpack this anyway. Still having a little fun this morning. So today's key macro question is the Bear Porn newsletter recession finally commencing? No, the answer is no. Our answer is the ratty October 2024 jobs report does little to discourage our conviction in our 2-plus-year-old resilient U.S. economy theme. If anything, we now have more conviction because of the likely bounce back in the November or December data. We continue to pound the table on the now consensus resilient U.S. economy theme we authored in September of 2022. Recall that at the time, we forecast that if a recession were to commence, it would not commence until 4Q 2023 through 1Q 2024 at the earliest. That was a heroic call in the face of then consensus recession fears that were broadly maintained until this year. Moreover, once we arrived in that 4Q 2023 to 1Q 2024 window of weakness, our daily Bayesian inference process consistently confirmed a low probability of a developing recession in the U.S. economy, a condition that has been maintained since. That fundamental research afforded 42 macro clients the confidence to take advantage of KISS and Dr. Mo's bullish risk management signals all year. We're really proud of that. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one is regarding the bond market. Reads, has the bond market ever ignored falling interest rates? Says, given the sovereign debt discussions for turning, et cetera, has there been a period of time when a central bank has tried to lower the interest policy rate to spur growth, but the bond market doesn't react as expected or care, and government bond yields continue to rise? Either inflation expectations are still high, lack of bond buyers are sure if they will receive their principal back, but the interest rate is still lowered in an effort to turn the economy around. I don't know if this is a plausible scenario, but given what I have been hearing on podcasts recently, I'm wondering if that could happen. Seems likely. I'm just not sure if I'm missing some mechanism between the central banks, Fed setting policy interest rates and bond yields. So the answer to this question is yes. Unfortunately, you are missing this, but this is why you have me here to answer the question. You are missing the mechanism. So I'll start by saying the central bank does not control bond yields. The central bank hopes to influence bond yields by setting the price of money at the short end of the curve, really at the overnight part of the curve. And what they're essentially trying to do is influence investor expectation of the terminal policy rate, which ultimately has a significant influence over the prices of maturities of debt securities that mature over different tenors. With respect to bond yields, obviously the market itself sets bond yield pricing. How bond yields are priced is a confluence of three things. One, it's the expected growth rate in the economy, which is usually some function of people's expectations of trend growth. It's the expected inflation rate in the economy, which is usually some investors' broad expectation of trend inflation in the economy. And then there's the expected term premium. And so the term premium is the premium you get as an investor for locking your money up over some various tenor, over a duration, over specific duration, as opposed to what you would get mathematically by rolling over short-term interest rates for that same time period. In theory, there should be positively sloped term premium in the market. You should be getting paid to take illiquidity risk if you're going to lock up your money, let's say for 10 or 20 or 30 years. But currently, right now, there's very little term premium in the market, which is something we focused on in our research here at 42 Macro vis-a-vis our investing during a fourth turning regime analysis, which has suddenly become all the rage. I think there's a lot more discussion about the profligate fiscal path that the U.S. is on, which is only going to accelerate no matter who wins the election. Spoiler alert. And ultimately, our view is that the monetary authorities' likely response to that is likely to create a secular bull market, continued secular bull market, which we've been on the right side of in things like stocks, crypto, and gold, most notably, and other assets as well, real estate, et cetera. So investors, just getting back to the question, have we seen times where the bond yield actually rallies and responds to the Fed cutting the policy rate? And the answer is yes. We've seen several of those instances historically, dating back to as early as the 1970s. We had one in the 80s, we had an instance in the 80s, we had an instance in the early 90s as well. I want to say we had maybe an instance in 2015, 16 as well. So there have been instances where we've seen bond yields rally in response to the Fed cutting the policy rate. And ultimately, it's a function of the investor expectations for growth, inflation, and ultimately term premia, which usually is less of a factor, but it has been a big factor in this backup. But usually changing investor expectations for growth and inflation rising, causing investors to demand those securities less. Go back to the entire Bernanke QE program, that was pretty large at the beginning of my career, which began on Global Wall Street back in 2009. We always saw that once the Fed started actually performing the QE, buying the bonds, we saw bond yields actually rise, which is counterintuitive. But ultimately, what it meant is that investors no longer wanted to hold the quote unquote least risky securities, and they wanted to move further out on the risk spectrum because the Fed, through its quantitative easing program, was reducing the supply of those securities and lowering the ex ante yield. So ironically, the ex ante yield started rising because people were selling them to the Fed and ultimately buying other risk assets, and that's how QE worked from a balance sheet substitution perspective. So, I put a pin on this question. It was a great question. Hopefully, investors are getting not hopefully. I know investors are getting a tremendous amount of value from my answers in this community. Not just my answers. I continue to be incredibly humbled and really grateful for the thousands of investors that are interacting with each other in this community, helping each other answer questions on specific things like, well, what do I do with my 401k? How do I do this? How do I do that? The stuff that I can't necessarily answer from the perspective of regulation, but they help each other better implement our research and other research views into their own portfolios. And so I'm really grateful for the community that we're building with a lot of really thoughtful investors from all across the sophistication spectrum. We got buy-side CIOs and portfolio managers interacting with mom and pop retail investors in our community in a safe way that you typically don't find in places like Twitter or Reddit or somewhere else. So super proud of that. Super proud of the work that we continue to do and the solutions we continue to provide for our clients. We're having another great year. That's 3 great years in a row, and we're really grateful for that. And so we'll catch back here on Tuesday. I'm going to be offline Monday, traveling back from a Sunday wedding. Who puts a wedding on Sunday in the middle of football season? I got to talk to my wife about her friends' choices, but that'll be a separate conversation. So everyone have a great weekend. Cheers.